Welcome back to Financial Wellness Planning. My name is Derek Coffey, and I'm the founder of FWP. And as much as we may hate paying taxes, it's just something that we have to do. We can argue back and forth about if our federal government uses those tax monies appropriately, but regardless of how you feel, the tax money that we pay in funds the services that we need to live our lives the way that we do. In this video, we're going to get into what income taxes are. We're going to cover FICA taxes, we're going to cover federal income taxes, and then we're going to touch on state income taxes. But my hope is that with this information, you can implement it into your financial plan and make it as tax efficient as possible. Stay tuned. So the first type of income tax that we're going to go over are what are known as FICA taxes. And the whole point of FICA taxes is to fund Social Security and Medicare. If you're a W-2 employee, which means you work for a company, you get a W-2 at the end of the year, and that's how you file your taxes, then there is nothing you can do to avoid these taxes. Of that 7.65%, 6.2% goes to Social Security. The other 1.45% goes to Medicare. And your employer also contributes that same amount. So for every dollar you put in, your employer has to as well. But with Social Security, there is an income limit. And what this means is that once you go through that limit, you no longer contribute to Social Security. In 2024, that income limit was $168,600. So for the first $168,600, you pay 6.2% of that into Social Security. Once you go over that, you don't pay anything else. On the other side of that is the 1.45% that you pay into Medicare. And unlike Social Security, there is no income cap on that tax. You pay that on every dollar that you earn. And once you hit $200,000 if you're single or $250,000 if you're married, you're going to pay an additional 0.09% into Medicare. So with FICA taxes, there's nothing you can do about it. It's going to be 7.65% of your income, but what you're paying in is hopefully going to benefit you later on. The second type of income tax that we need to go over are federal income taxes. And unlike FICA taxes, there are things that you can do to reduce the amount of taxes that you owe. Now, with the U.S. tax system, it's set up to be progressive, meaning the more money you make, the more money you pay in taxes. I know that's not always the case because our tax system is so convoluted, but when it comes to income taxes specifically, it is fairly progressive. The U.S. tax system is broken down into 7 marginal tax rates. Depending on how much money you report as taxable income, that's going to determine what your tax bill is going to be. Now, we're going to get into the calculation of taxable income here shortly, but what I don't want you to do is confuse your gross income for your taxable income, because they can be two vastly different things. Before we can begin calculating what your taxable income is, we need to go over deductions. And what deductions are a legal way for you to avoid paying taxes. The first type of deduction that you're going to use is what is known as an above-the-line deduction. So anything you contribute to a retirement account, anything you contribute to an HSA, any health insurance premiums you pay before taxes, all of these things reduce your gross income. Once you've factored in all of your above-the-line deductions, that's what's going to give you what is known as your adjusted gross income. You're going to take that figure and then you're going to reduce it by your below-the-line deductions. Now, below-the-line deductions for most people are either going to be itemized deductions or the standard deduction. For most of the people that are going to find value in my content, you're going to use the standard deduction. If you do itemize your deductions, make sure you're using an accountant to make sure that it's all done properly. But if you're not itemizing, you're going to use that standard deduction. In 2024, the standard deduction for a single filer is $14,600. So of your adjusted gross income, you're going to reduce that by the standard deduction, and that's what's going to give you your taxable income. If you're married in 2024, your standard deduction is $29,200, which is simply a doubling of the single standard deduction. And you're going to notice that it works the same way with your income brackets when we calculate what your tax bill is going to be. So to help you understand how your taxable income is calculated, we're going to work through a quick example. So let's say that you're married, you make $100,000 gross. The first thing we need to figure out is what your above the line deductions add up to. So if you take 5% and you contribute that to your employer-sponsored account, and then you pay $6,000 on a pre-tax basis for your health insurance premiums, then your total above-the-line deductions are $11,000. That's going to give us an adjusted gross income of $89,000. We're going to take that figure and reduce it by the standard deduction, at least for this example. So in 2024, you're married, your standard deduction is $29,200. We subtract that from the $89,000 of adjusted gross income, and that leaves us with a taxable income of $59,800. So now that we understand what our couple's taxable income is, we can figure out what their federal income tax is going to be. And when it comes to calculating what your income tax bill is, it's very much like filling a cylinder. Now, I didn't come up with that. I read it somewhere, and I apologize for not being able to give credit where credit is due. But it is the easiest explanation of how this works. So of the taxable income, because they're married, the first $23,200 that they report, they're going to owe 10% of that in federal income taxes. So their federal tax bill on that first $23,200 is $2,320. And then the rest of their income, they're going to owe 12% in federal income taxes. So they fill up the 10% bracket, everything else above that goes into the 12% bracket. It's very much like filling a cylinder. So with the income that's in the 12% bracket, we do have to do a little more math. So their taxable income is $59,800. We've already paid taxes on the first $23,200. That's going to leave them with $36,600 in that 12% bracket. We multiply the $36,600 by 12%. They owe an additional $4,392 in taxes. We take those two figures, we add them up. Their total federal tax bill on $100,000 of gross income is $6,712. The next thing that we need to go over are tax credits. So once you calculate what your federal income tax bill is going to be, you need to look into what tax credits you may qualify for. Unlike a deduction, which only reduces your taxable income, a tax credit actually reduces your tax bill. There's a long list of tax credits that are available to U.S. taxpayers, and an accountant is going to be the best in determining which ones you qualify for and which ones you don't. But with tax credits, they're generally broken down into three different types. You have the reduction-only credit, which can only reduce your tax bill to zero. If you had any additional credit left over, you may be able to carry it forward into the next year, but with the reduction-only credit, your tax bill can only go to zero, at least for that year. Next, you have the partially refundable tax credit. And what this means is that if the tax credit is large enough to make your tax bill a negative, you may not necessarily get that full amount as a refund. You're only going to get a portion of it. And then the final type of tax credit is the fully refundable. And if your tax credit puts your tax bill below zero, then that entire amount gets refunded to you when you file your taxes. Now, to help you understand how tax credits work, we're going to carry on with the same example that we just went over. In that example, we calculated their tax bill to be $6,712. If they had a child and they claimed the child tax credit, they get to reduce that by $2,000. So we subtract that from their federal tax bill, the actual amount of federal income taxes that they owe, $4,712. The final type of income tax that we're going to go over are state income taxes. And I'm only going to glance over these because depending on the state that you live in, your situation is going to be different. There are currently 7 states that do not collect an income tax of any sort. Alaska, Texas, Nevada, South Dakota, Wyoming, Tennessee, and Florida all do not collect state income taxes. There are 2 caveats to this, which would be Washington and New Hampshire. In the state of Washington, there is no income tax, but it is highlighted here because they collect a 7% tax on capital gains. In the state of New Hampshire, they do not collect a state income tax unless it's on dividends and interest, which they only charge you 3%. So depending on the state that you're in, you need to be aware of the tax system that's in place. Some states have none, some states have a progressive structure like the U.S. tax code, and some states have a flat tax. But again, depending on the state you live in, you need to be aware of what you're paying. The final thing that I want to go over with you when it comes to income taxes is the difference between a marginal tax rate and an effective tax rate. In a lot of cases, these terms are used interchangeably, and for most people, it can't be any further from the truth. Your marginal tax rate is what you would owe if you earned one additional dollar. So, for the couple that we used as an example, they made $100,000 of gross income. Once we figured out what their taxable income was, their marginal tax rate was 12% because that's the highest percent that they paid in taxes. If they earned $100,001, that one additional dollar is going to be taxed at 12%. This is vastly different than their effective tax rate. On that $100,000 that they brought in, even before we factored in the child tax credit, their tax bill was only $6,712. If we divide that by the $100,000 of gross income, their effective tax rate is 6.7%. And then if we do factor in the child tax credit, which reduced that tax bill by $2,000, their effective tax rate was 4.7%. This isn't even close to what their marginal tax rate was. So, understanding the difference between these two terms is what's going to help designate what you do with your money. If you're in a position that you need to save on taxes now because you anticipate your tax bill in retirement being lower, then you're going to save money into a pre tax account, something that's going to save taxes for you in the present. If you anticipate being in a higher tax bracket later on, then you're going to want to save into something that's going to create tax free income when you retire. So, as long as you understand the difference between these two terms and how the overall tax system works in the US, you can use it to your advantage and create a financial future that is as tax efficient as possible. I want to thank you so much for tuning in. If this video or any of the other videos that I've put out has provided you value, then hit that subscribe button. If you know someone that doesn't have a clue as to how their income tax bill is calculated, then send this video to them. Maybe it'll help them understand that it's probably not as bad as they may think it is. But I thank you so much for tuning in. I'll talk to you soon.